right. Hello, everyone, and welcome to our second IEA podcast for 2021. This is our second? It's technically our second. Our first one was kind of like a goodbye to, like, hello, everybody, welcome back.
No. This is our first. This is the first week of. This is the first week of January.
So this is our first one. Okay, everybody, this is our first podcast for 2022. And this is one I'm sure many of you all will enjoy and want to share with your friends, because the question is, why is the stock market and the cryptocurrency market having such a rough start to the year? Some of you all have seen dips in your account. Some of you all have seen dips in stock account, cryptocurrency account. Now, we have been doing continuous masterminds about this. So we've been covering it and figuring out ways to benefit from it. And if you are not part of a mastermind, you should contact both Leon or I, because in our cryptocurrency mastermind, we only have two slots left, two or three slots left. Yes, I believe that's accurate. And in our investing platform, which is the IEA Panthers, we have definitely, I think, also two or three slots left. But the difference is, once the IEA Panther group, which we invest in private equity deals together, we bought land in other countries. We're looking. We also, they're part of the cryptocurrency purchasing and education piece. But that is $5,000 a year. Once these last two slots are filled, the price goes up to $10,000 per year for anybody who wants to join. And honestly, for us at this point, who joins, it's really a benefit to you, because we are enjoying some really great investments. And in the end of the day, we're going to continue investing whether you join or not. So it's not a threat, but it's the truth. So in 2022, we hope that you take the time to say, you know what, let's get serious about investing. I want to look into joining a mastermind. Again, we've said it all the time, even if it's not ours, become part of a community, because what's happening in the market is happening so fast. It's truly hard to keep up with for any one person. And even if you do keep up, just having a singular vantage point of what's going on could hurt you. So I am going to do what I always do, and that's going to be a little bit of housekeeping while Leon told you why we chose this topic. But in that time frame, I really want everybody to think about, what is it you're trying to accomplish from 2022. We know some of you all have set your what's it called when you New Year's resolutions?
Yeah.
I don't even really believe in them. I think you should always be striving to be better. So I don't know the word, but if you have New Year's resolutions and it's financial related, help us get you there. Let us help you get you there, and become part of Investing Education Academy. You can go to www.ieanow.com, figure out which membership platform looks the best to you, and join, because this year it's going to be a great year, because right now we're set up for some good things. So Leon, you can tell them why. I'll do some housekeeping.
Yeah. So this is everyone who's in the market knows right now the market has crazy volatility. And like Brent said, we've been talking about this for about the past 2 months, and we prepared everyone who either follows the podcast or is a member of our community. We've been preparing everybody that this volatility was coming, primarily because of what the Federal Reserve is doing. The Federal Reserve, people don't know, their main function is they control interest rates in the economy. And interest rates, for people that don't know, are very, very important to the monetary system in the United States. And so what happened today? So yesterday was a bad day in the market. Today was even worse. NASDAQ today was down, I think, over 3%. And yesterday, the general market was down close to 2%. So it's been a terrible past 2 days in the market. But again, we kind of anticipate this was coming, and I'm going to tell you today why this happened. So yesterday, so this all surrounds interest rates, right? So we've been talking about this since day one, since the COVID last March, March 2020, the Federal Reserve lowered interest rates to effectively zero, which made money essentially free. So you can go out there. Before, you could have gone out there and gotten a personal loan, a business loan, what have you, and the interest rate would have been close to zero-ish, maybe 1%, maybe a little less than that. But when it comes to interest rates, it was effectively zero. So what was happening was a lot of companies and individuals are going out here borrowing all this money and trying to buy, because we're coming out of a pandemic, all these economies are opening back up. So you have a lot of money chasing few goods. So cars are in short supply, semiconductor chips are in short supply, computers, clothes, anything. That's why inflation is running rampant, because you have all this money chasing few goods. So the Federal Reserve, one of their two of their mandates are one, control interest rates, but their main one is to control inflation. Right now, inflation is through the roof. Last year, inflation was about, I think the end of the year was like 6.5%. So what that means is the dollars you have sitting in, we always said the savings accounts, lost about 6.2 to 6.5% of buying power, because the price of goods went up and the value of your money sitting in a savings account didn't really move. And so what the Fed is doing right now is just saying, look, okay, rates are effectively zero. So in order to stop this runaway inflation, the Fed has to now start raising rates. And what that does, and the reason that affects the stock market is because we said this before, when you have millions or billions of dollars, you would much rather take $500 million and sit it in a bond at 2.5%, and earn. I think I did the math earlier. 500 million. Sorry, I can do what it's right now. So right now the 10-year Treasury is paying 1.7%. 1.7% of 500 million is $8.5 million. Because Treasury bonds are backed by the United States federal government, that's essentially guaranteed. The federal government has never defaulted on any of its loans, and it most likely never will. So basically, you're locking in 1.7% of 500 million or $8.5 million, pretty much guaranteed. You can take that, or you can go put it in the stock market, which we all see right now is down about 7% over the last 2 days. Can have 20%, 30% corrections all over the place. So when you have big money, you're like, yo, when these rates rise, they're taking all that big money, some of that big money out of the stock market, and they're putting it into safer assets, interest-bearing assets that Brent and I have been telling you from day one are not good for us, because we don't have, when I say we, I'm saying us as in the retail buyer. The amount of money we're putting into something like a treasury bond at 1.7%. If you put $100,000 in that, it's not a big return, right? It's just not enough. It's not enough return for the amount of risk we're taking. So it's better to put our money into the stock market, even with rates moving around as they are. The risk reward for us when we have smaller amounts of money is still better in the stock market, which on average returns 10 to 12% per year. So that's kind of a nutshell rambling on what this is about. So what happened?
Leon, real quick.
Oh, sorry.
I want you all. I know somebody out there thinking, well, they just made 1.8 million, and you always tell us not to keep your money in savings account, and so why, or traditional investment type accounts or bonds and things of that nature. So why is it
8.5 million on the 500 million?
8.5 million
at 1.7%.
So at 1.7, they're still not keeping pace with inflation, right? Mm-hmm. Somebody somewhere is thinking that if they listen and have been listening to us. Okay, now let's talk about reality versus what is conceptual. The reality is that if you're making $8 million on your money in a year, cost of goods sold in the US, you can afford pretty much whatever you need to survive and a lot thereafter. When you're putting in, $100,000, like Leon said, and you're getting 1%, that $1,000 isn't buying you a whole lot of anything. And so you have to look at the size of the money going into the investment. And I stopped, just did that break because somebody mathematically is going, well, you always say it's not keeping pace with inflation, and that still isn't keeping pace with inflation. So why would institutional or big money be doing that? Because they're making still 8, in some cases they're putting in $1 million. So you're talking about 16 million in a given year. So you can do everything you need to do with that kind of money. Inflation almost doesn't matter at that point. Almost. Then you take the person who just has $10,000 or they have $20,000. You're getting decimated being in these accounts, because now you can't. It's not 16 million. You can't walk out and just buy a car if you need a car, if your car breaks down. On the interest your money is made, you have to start cutting into your principal to pay for things that may be everyday needs, like the air conditioner breaks. You're putting your kids in private school. A parent is ill. Somebody has unexpected medical bill. It can literally wipe out your savings. And so that's why we want you all to know. And that's why I just wanted to interject real quick, because somebody may be thinking a percentage is a percentage is a percentage. Yes, Numbers don't lie. That's correct. However, the amount of principal going in on the front end does matter. So I just want to say that.
And to that point, also you got to think about a lot of these hedge funds. They're not just hedge funds, also, right? They're also like endowments at colleges. They're pension funds. Where essentially the companies that are managing these funds can't lose money, right? Like you can't. I mean, of course, anything's possible, but your mandate is to not lose. Like Warren Buffett said, rule number one is to never lose money. Rule number two is to remember rule number one, right? Don't lose money. If you have your money sitting in a pension, you don't really care about inflation. You don't care about our stuff. Me and Brent be talking about. Take my 500 million, put it away where it will not lose money. It won't keep up with inflation, but you're still going to get 8.5 million back, right? And like Brent said, reality is we got to look at conceptual versus reality. But we're talking about for us, our community, when a lot of us don't have multi-millions or billions of dollars, these interest rate numbers actually matter. When you're dealing with that size of money, millions and billions, interest rates matter a little. They still matter, but the cost of inflation isn't as important because, as Brent said, you're still getting multi-millions back on your money. So yeah, just make that distinction that some of these big funds literally cannot lose money. They cannot lose people's retirements, lose people's pensions. So putting in something that's paying 1.7%, they almost have to do if it presents itself versus a very volatile stock market. Okay, so to the topic today. So what happened today, right? So the market was down huge today. Like my account took a absolute beating. Horrible. But I did a little buying today as well. And the reason it took a beating was what came out today is what's called the Federal Reserve minutes. So these are the minutes or the notes from their most recent meeting, which I think was last month. And before some of the things I'm gonna talk about now, we actually talked about before. But now they're actually set in stone, right? They were kind of hearsay, and they may or may not do this. Now it's fact. So what Brent just put up is a slide. Slide is titled "Why Have the Stock and Crypto Markets Started the Year So Rough?" We're gonna go through why. Today, the Federal Reserve came out with their minutes, and the number one thing we talked about this before, but the number one thing at the top of that list was that the Fed is now saying they will speed up taper. All taper is when the Fed is buying bonds every month. It's some hundreds, either tens of millions or hundreds of millions of dollars per month in bonds. What that does is artificially keep rates low. Well, the Fed is starting to taper that. So what all taper means is they're lessening it. Every month between, I think it started last month, every month through March, they're going to start, be buying less and less and less, tapering the amount they're buying. And then it's going to end around March. So they'll stop buying bonds altogether around March. And as they're doing that, because remember, when they buy bonds, it keeps rates low. As they taper it and lessen the bond buying, rates are going to start ticking up, right? Because you're not going to have that buying pressure on the bonds. That's number one. Number two, they came out and said they're targeting March to be the first rate hike for the year, right? So, and that's the first rate hike of potentially 3 rate hikes. So again, the reason this affects the stock market is because all that big money is seeing, these rates are going up on these relatively safe and almost guaranteed assets like treasury bonds. They're licking their chops to take some of these hundreds of billions or millions of dollars to drop it in something that's safe and will guarantee them a return. So in March, they've identified as the first month to actually raise rates. I just want to make a quick distinction. When they stop buying bonds, rates, the market, I'll just say the bond market itself, just by virtue of people selling their bonds and wanting to buy bonds in the future that have higher rates, is also going to start raising rates. So you have basically what you're having the Fed stop buying bonds or tapering their bond purchasing, and then you have people in the bond market saying, "Look, I'm gonna get out of these bonds that are paying me nothing because I'm gonna go buy the bonds that are gonna pay more in the future." So there's all this pressure now to raise interest rates, right? So rates are gonna start rising. That's number two. Number three is an important one too. So right now, the Fed has been buying all these bonds, and they've been sitting on the Fed's balance sheet, right? All these bonds they've been buying for the past year and a half. Well, what the Fed is going to start doing, they're going to start actually selling these bonds. And I make this point that bond buying and interest rates have inverse relationships. So the Fed has been buying bonds, lowering rates. Now the Fed is going to start emptying its balance sheet of these bonds, which is effectively selling bonds, which is going to make rates rise, right? So you have all of these 3 major things the Fed is doing that are going to start pushing rates up. Now, point number 4 is the biggest reason we've seen this colossal move in the stock market the last 2 days. So typically, bond rates move about 0.50% or half of 1% per day, right? Roughly. I mean, sometimes a little more, it's a little less, but bonds don't really move, right? They're kind of stagnant. The interest rates on bonds. Just in less than a week, last Friday, 12/31 was last Friday, through today, the 10-year Treasury bond interest rate is up 13%. I'm gonna say that again. Bonds typically move half of 1% per day, right? So a 13% move in bonds, you may not even see that in a decade, right? We've seen that big of a move from low to high through today, 13% move in bonds in less than 1 week. And that's why you're seeing all this sloshing around in the market going crazy, because people are now all these different algorithms and all these different big money players are now having to move money out of the market to go to cash, to position themselves to buy these bonds that are going to be going up and up and up in price. So what's happening right now, and I said this earlier on the platform, is that it's a reallocation of trillions of dollars, trillions with a T, trillions of dollars right now are being reallocated from options, from crypto, from the stock market, from real estate, whatever, to put into cash, and then they're going to start buying treasury bonds in the future, in the next couple months, or even later this year. So that's what's causing all this volatility in the stock market. That's why the stock market again today was down so much, primarily tech stocks, because as we've always said, tech stocks that do not have profits get hit the most. So we've always said, look, if you have profits, like I started doing this like a month ago. All the either the SPACs or the non-profitable IPOs, or even some tech stocks that are smaller that really had no profits, I got out of some of them, or paired my position in some of them. I'm definitely not buying any new speculative tech. But if you do want to still buy tech, you want to buy tech that has profits, that has like durable profits and/or even dividends. Because what you want companies that have solid foundations. Those are the ones that are going to benefit going into the future, versus these really small speculative stocks. So that's what caused all this turmoil today. Is really bullet number 4, is how rates have risen so fast in the last week. That's causing all these different big money centers, big money firms to reallocate money out of different other asset classes into cash and get ready to start buying bonds in the future.
Yep. And so for anybody who's watching and you still have questions, I definitely invite you all to join our Facebook group where we can continue the discussion, talk about any questions you may have. You can go to Investing Education Academy, put it in the search bar on Facebook. You can find our group and talk to the other members about what's going on in your portfolio. And it's interesting. We've been getting phone calls and people have been touching base with us about the market. And it's one of those things, like when the market's going really well, people think their strategies are untouchable. Like if for some reason they go into this mindset that the market will continue printing money no matter what they choose forever. That's not the case. There's times to reallocate your accounts. There's times to think about like what am I holding? Why am I holding it? Should I hold it through this period? And if you don't know what you're doing, you need to talk to a professional, because this is where a lot of people lose everything that they made, and then they're just mad at the market. When in reality, they should be mad at themselves for not being in the right environment to take advantage of the market. So there's just something to consider while you're looking at what's happening inside of your accounts. Now, with that being said, we owe you 2 things. That's 2 stock picks. We got to get back on our jobs. I will admit I have been slacking. Leon's been picking up my slack. So it was a couple of days. I was like, oh no. So today we are good. We're ready to go. It's 2022. We're gonna start off positive. So we're gonna give one of our stock picks will be inside of our Facebook group. The other stock pick will be inside of the membership platform for Investing Education Academy. Again, if you are not a member of Investing Education Academy, I really implore you to at least consider it. Give it some strong consideration, because this year is going to be a year where I think you should surround yourself with experts, because the things you think you may not know. And the things that you do know, I think it's great that you should want to share it with other people. So, yes, with that being said, Leon, is there anything else before we sign off?
Yeah, I just want to say that, so inside the membership, we put out a report that basically kind of summarized 2021. We identified the sectors that did great, and we identified the cryptos that did well, and what we're going to do going forward now. So that was kind of a report of 2021. What we're going to do going forward now in 2022, because 2022 I don't believe is going to be similar to 2021. The sectors that won in 2021, just the way things are setting up with the Fed, I don't believe will be the same as it went in 2022. So with members, we're going to be kind of walking through the sectors that we feel are going to win this year, why, and then the particular stocks in those sectors to look at to potentially add to people's portfolio. So we're going to kind of help members through this rough time right now in the market going forward into 2022. Because again, I don't think money's going to be as easily made this year as it was last year because we don't have the Fed at our back anymore. The Fed is now they're now what's called hawkish. They're looking to raise rates. They're being aggressive with it. They're really saying they got to slow down this inflation, which they do. I mean, that's their mandate. And when money becomes more expensive, investments or the easy money is harder to make. So so I just say that to say we're going to be working with our members and our communities to identify the sectors and stocks that should do well in this type of environment.
Yeah, and I just looked up a stock, so I'm gonna leave the name out of it. But since in the last 30 days, the stock has been down 28%. In the last 5 days, it was down 22%. In the last 1 day, it's been down 9.2%. Now, the reason why I say this is because it's a stock that we've been bullish on, and this is very important. We always talk about stop timing the market and have time in the market. If you take this stock that I just told you was down 26% in 1 month, 22% in the last 5 days, and down 9% today, if you go out 5 years, this stock is up 875%. And I'm gonna say it again, 875%. And the reason why I say that is the new people who are coming into this marketplace and they see this. If you look at the 1 year return on this stock, it's only 36%. Again, once 36% is still great, but in the past 12 months, it's up 36%. This stock, if you've held it for the last 5 years, you're talking about 875% rate of return. And this actually is a stock that we own. But just understand there's time and a place where certain stocks make sense and others don't. And so, and if anybody wants to know what the stock is I'm talking about, come to the membership platform and send me a message and I will tell you what the stock is. But other than that, we just wanted the information. That's what's the really important part, to know that when you look at things in isolation, it can look really bad. But when you look at it in totality, it can not only look better, it can look fantastic. Stop trying to time the market and start focusing on having time in the market in the right investments.
One last point is that so like I was saying earlier, the reason the Fed is raising rates is because the reason they're doing this is because inflation is running high. And what that ultimately means, the economy is doing great. This is actually a good thing, right? So it hurts right now in the market, but it's actually a good thing because, like I said, what's happening before is you have consumers spending money like there's no tomorrow. They're trying to buy everything they can. Because remember, during the pandemic, the U.S. consumers saved about $4 trillion with a T dollars in their savings accounts. So all that money now is being pumped into the economy, and it's raising inflation like crazy. So don't think that rates being raised is a bad thing. Rates being raised is actually a good thing. And we actually did a podcast on this last year that showed the years when the Fed raises rates typically outperform an average year. So the Fed every year the stock market does about 10% per year. I believe the years when Fed raises rates, the stock market on average does about 15% per year. So it actually does better because, again, they're raising rates because the economy is strong. So this is not a bad thing. It's not a bad thing at all. It sucks right now because we're all getting hit by it. But as we always say, long term, everything kind of settles down and smooths back out. So just know that this isn't a bad thing.
Yep. Time in the market, not timing the market. And stay away from those get rich quick people because a lot of times only people getting rich are them. So with that being said, we look forward to seeing you all next week. To find the stock picks, you can go to the Facebook group. You search Investing Education Academy, join the group. It's a lot of great information in there. If you want to become a paid member inside of Investing Education Academy and unlock everything that we put in, you can go to www.ieanow.com. We look forward to, really spending the next 12 months with you all again, providing great information and growing our community. And hopefully, as a result of growing the community, we'll help you grow your revenue. All right. Have a good day, everyone.